Hi everyone, Michael McVety here at Red Fortress. Welcome back again for another video. Today I'm going to be talking about a pretty fascinating topic for those people, even if you don't like numbers, okay? We're going to be talking about kind of like my comments and thoughts on the 2026 Fed Reserve luncheon that we had. So last year I was there and did a video on what the Fed was thinking about our economy, inflation, that sort of stuff. So I went back again this year. It was approximately 2 weeks ago that I saw it, but I've been producing other videos on fourth quarter analysis and so forth. So I wanted to get around to letting you know what the government thinks, so to speak, or the Fed, which is not really the government, but you understand what I'm saying, what they think regarding our economy, what they think about interest rates, which is going to probably affect you with your investing. So without further ado, I'm Michael McVety, president of Red Fortress Property Management, been a landlord here in Southwest Florida for 25 years, a property manager, second generation property manager for the last 30. Without further ado, just wanted to go over a couple of key concepts here. First of all, Sherry Bauer was is the regional executive for the Miami branch of the Fed, which the headquarters of our district is up in Atlanta, Georgia. So she gave a presentation, same lady did last year in 2025, did a great job as always. And I'm going to be actually showing you most of the slides that she actually presented. So they're actually, her original slides, so you can see exactly what they're saying. And as well, and when we talk about economic or fiscal policy, sometimes they're used interchangeably. You're talking about taxation and spending, and that's more of what the government does, right? Like Congress, the Senate, the president having thoughts on how to do certain things. It gets a little bit complicated that way with budgets and so forth and continuing resolutions, but that's the economic or fiscal policy that's done by our elected officials. But then when you talk about monetary policy, that's exactly what the Fed does. So the Fed kind of looks at what's happening, and then it decides whether they're releasing more money or less money into the market and at what interest rate to try to control the market. Okay, so where we're headed today. So we're going to talk fairly briefly about the view of the Fed towards our economy. Then the view of the economy also affects their view on unemployment and employment and what they should do there. And then finally, their view of what is happening with inflation, and that directly affects kind of like what they should do with the interest rates, okay? And then finally, I'm going to talk about my 2025 as well as 2026 prediction. So how did I do last year? I have the actual slide. You can look it back to make sure that what I'm saying is true. And then I'm also going to make predictions for investing in 2026. Okay. So the Fed's mandate is dual. Okay. So in other words, the role of the Fed is to maximize employment as well as create stable prices. So typically when we look at stable prices, we're looking at how does that affect or how is it affected by inflation? Inflation, obviously, they want it at that normal 2% rate. If it goes below that, they're very excited. If it gets higher than that, they get concerned. Okay. Now, the interesting thing about maximum employment is that there's no actual target that the Fed says towards maximum employment. So, what is maximum employment? Is it 2%, 4%, 6%, that sort of thing? And generally speaking, the consensus, if you can use that term, would be around just a little bit above 4%, maybe 4.2%. Okay, so that's something to look at. Now, here's what they were looking at for the economic snapshot of 2025. So they weren't sure what was going to happen in 2025, but like they say here, based on their available data, they believe that the GDP, the gross domestic product, our actual economy, this the major way of how we kind of look at it, is going fine. And then also consumer spending, they said, was stronger than expected. They also felt that the labor market was softening a bit. We're going to get into that. And then also they said that, again, the inflation rate is still stuck. So even though it's come down, it's still kind of stuck at about 2.6%. So it's come down, but it's higher than what they'd like to see. Okay. We're also going to talk about the gross domestic product in a little bit as well. So when they were looking at 2026, they had a couple of concerns. First of all, actually they had a couple of major concerns. But first of all, when they were looking at the economy, they felt obviously that the government shutdown didn't help our quarterly pace for 2025. And the reason why is because when you have a government shutdown, it shows the rest of the world that there's increased stability, right? Do we have our house in order? That sort of stuff. Obviously, tariffs was a major concern for them, but as we'll see later, not as much as they believed. Okay, the nation's top 10% earners account for nearly half of the national spending. So the wealthy are spending a lot right now. That's the reason for the increased consumer spending. Okay, we'll talk a bit more about that. The employment data, they're all over the board on what's going on. They're not certain. And the final point about this consensus and where they're starting to have a lot of divergent opinions is the 12-member board really doesn't know what the greater concern is. They can't seem to get inflation under control. It's at 2.6, so it's better, but it's not where they want it to be. And yet they also have some concerns about the economy and the rate of unemployment. So there's this balancing act that they're trying to do, and they don't know how to take care of it. So let's get into some of the slides, and you'll see a little bit of where they're going with regards to the economy and inflation and unemployment and that sort of thing. So first off, like I said, they believe that the GDP was impacted to some extent, a little bit, not as much as they thought, regarding tariffs. And also, they had the government shutdown. So, like they said, that's going to affect our economy and how much we produce. Okay, but here they believe that the fourth quarter is going to be less than 1%. Now, right now, the rate they're talking about might even be greater than the third quarter, which would be awesome, right? So it's interesting. They're talking about maybe the projected growth is 5%, not 0.8%. Okay. And then they believe that in 2026, it's going to be on average about 2% GDP. And then they think it's going to cool off. Okay, we'll get into why they think that in a little bit. They believe that the reason why there was such good growth in the third quarter was it was strong consumer spending. Like again, the wealthy, like they were saying, were spending a lot of money, comparatively to other people, but also AI. The particular investment in AI as well as the infrastructure has been in the trillions of dollars, so huge amount of investment that's starting to pour in. And when we were talking about the economy, they call it the K-shaped economy. So you might not know what that term means, but the K-shaped economy basically refers that kind of like a K, that not all the benefits of an economy are affecting people like the higher, the middle, and the lower class, right? So that's been the case forever. But they're talking about what happens with interest rates and that sort of stuff. And I won't get into that. That's a topic if you'd like for another video. But basically, they were saying, like before, they were saying that after increasing at similar levels for the last 2 years, the spending has diverged this year. They're talking about the higher percentage of people like with more money are spending more money. The people that don't have as much money are spending less at 0.7%. So what they're saying is the top 1/3 of earners are spending 4% more this year. Other people, they only increase about 1%. Okay. Interestingly enough, they talked about credit card and they say that their spending rate on credit cards is higher, but they're still being paid. So that's a very, very good sign on their behalf. Again, they talk about unemployment rate remaining consistent with a labor market. So you can see it still pretty much went down slightly. It's still very, very stable. So they like that sort of thing. And when you're talking about kind of like that entire concept of unemployment and what's going on with wages and so forth, and then we'll get into kind of like what's happening with various sectors of the economy. But then basically, they're talking about this graph here. This is December 2019. We're basically talking about pre-COVID levels, okay? Then they talk about June, kind of like June of 2024. These two areas are, 2024. Then you have June of 2025 and December 2025. And so basically, they're saying that the average hourly earnings is back to basically where it was pre-pandemic. So it kind of inflated a bit in 2024. Now it's come down. Now what's interesting is that they were saying that the good producing industries are actually up, meaning manufacturing, basically. They're saying that the private service providing is basically back to pre-COVID levels. So when they're looking at people's incomes, they're saying, okay, well, basically, we're back to where it was pre-COVID. So that's kind of again like more in line with inflation, what they're trying to do. Then they talk about employment growth. And this is a crazy graph here, but they're basically looking at, you can see when we hit like 2025, they're talking about 50,000 jobs versus say 200,000 at the beginning of the year. And the reason why, in part, is because you see this orange bar, if you want, those are government jobs that have been lost. So over time, people retiring or early retirement, that sort of stuff. The Trump administration as well as Congress has been working on trying to reduce the size of government. Don't worry about it. There was like 2.9 million people working only for the federal government, so there's still plenty of people working. But you can see that at some point they've lost like 80,000, 50,000, that sort of stuff. So that's one of the reasons why you don't see a large number for employment growth. And then when we're talking about immigration, this is interesting too. So when they were saying that the wages were still the same, basically pre-pandemic, what's interesting is that you have to keep in mind that we've had, an aggressive immigration policy enforcement towards people that are not supposed to be here in the country, that are undocumented, as they say, or illegal. And so there's been approximately 2.5 million people less in the United States. For the first time in 50 years, there's been what's called a net migration in the negative, meaning that more people left the United States than actually came here legally. And so when they're looking at this, they're talking about how in 2056 that the American population itself will start to shrink, in part because this is the net migration, okay? But they're also saying that the births versus deaths, at that point as our population ages, then the amount of people coming into the country will now be equal to the amount of the difference between deaths and births. Okay, so they're saying that, like, they're looking at this going, well, we're not sure how this is going to affect the economy as you lose people or as you have less people here in the economy, like in the United States. How is that going to affect the economy, right? So they're kind of concerned about that, and yet the gross domestic product might be in the vicinity of 5%. They're predicting less than 1%. Nobody today is predicting that the GDP is going to be less 1%. So they can be obviously wrong, right, with what with their predictions. Quick graph on inflation. Again, this is basically looking at, they want to make 2% their target. These are various ways that they look at the inflation. Sometimes it involves energy and food. Other times they take it out because energy obviously can go up and down. So basically they're around 2.6%, which is under control, but they'd like to have it lower. Okay. When they were looking at core prices with regards to tariffs, what's interesting about this is that they were saying basically that the goods are fine. The goods are coming in at 2%. It's the core services. The core services are higher. That's what's pushing our inflation rate at 2.6. So goods themselves are fine. The services are a little bit higher than they want. Okay. And when they were talking with CFOs, chief financial officers, about like the future, what's interesting is that they were saying, no, from 2025 to 2026, they believe that the unit cost growth, they think, is going to a little bit less have to do with tariffs than actual this entire concept of inflation, right, in services. So you can see the price growth here. They're saying, hey, in 2025 we thought 1.3% of it was going to be because of tariffs, and 2.6 because of non-tariff impacts like inflation. Now you can see that the tariffs, they don't even believe that the tariffs have any effect on the cost of their services or goods. They believe it has to do more with this kind of concept of sticky inflation, that things are just kind of expensive because they're just expensive, and it's not having to do anymore, they believe, with tariffs. Okay, so having said that, let's talk a little bit about what they think is going to happen, generally speaking, with the interest rates and what they loan money at. So obviously, interest rates are very important. They affect what mortgages you can get if you want to buy. They also affect adjustable rate mortgages, credit card interest rates, all kinds of things. So the lower, generally speaking, the interest rate, the better it is for your expenses. But of course, maybe it is also offset by how much money you might make by putting it into a bank or CDs and so forth, right? So here's a general kind of what they were showing. If they believe that there's going to be slower population growth, in other words, our immigration policy, we're taking people out of the country, people are not coming here either legally or illegally as much. And so what they're saying is that typically forces the inflation rate down, okay? Which would be better if you're trying to get money or be loan money by a government or bank, that is. When you look at the higher productivity, so as the GDP goes higher, okay, as the economy grows, they normally think that that's going to have an effect and raise the actual interest rates. Okay, why is that? Well, as the economy grows, they don't want it to quote overheat, where all of a sudden wages are going crazy, and that as wages go crazy and the economy picks up too much, that's when they say, well, okay, we have to kind of slow it down so that inflation doesn't go up to 3, 4, or 7% like it did under like 4 years ago with Biden's presidency. And then when they talk about the higher debt and deficits, well, typically what happens is that higher debts means that it's going to push the rate up because we're trying to sell bonds. We want to make our debt bought by people, and to do so, you raise the rates and give people a higher rate of return. Okay, so when you're talking about this, again, the Fed's looking at it and going, geez, you know what? We really aren't sure what's the bigger concern. Tariffs seem to be under control now, but inflation's still higher than we want it to be. The unemployment is okay, but we're not exactly adding a lot of new jobs. But then again, we're not sure what's going on because we've had 2.5 million people taken out. So how does that out of the countries? How does that affect everybody's wages? So you can see where they're confused. And this is a great graph to show absolutely how confused they are. So again, the FOMC is the Federal Open Market Committee. There you go. If nothing else, that's what the only thing you want to learn in this entire video is the Federal Open Market Committee. And these are the guys that kind of vote on reducing the interest rates by, a quarter of a point or an eighth of a point or that sort of stuff. So you can see in 2025, they predicted like, yeah, we think it should be around, 3.75% or 3.5 or something like that. And they were all pretty much in line. Look at what they're predicting for the future. Like they are all over the place. They're like, it can go from close to 4% that we lend money to banks at to almost like 2%, like scattered all over. And then even in 2027, the thinking of this committee, the guys that make the decisions and women, they're all over the place. That's why you heard for the first time, well, they lowered the interest rates, but like there was dissent, like it wasn't universal. Well, accordingly, because of various things, you're not going to see a lot of unanimity anymore. I'm glad I could say that word. It's going to be scattered all over the place how people view things. And just like bring it a little bit closer to home in Southwest Florida, and I've talked a little bit about the rental market analysis and what's happening in our marketplace. But like in October of 2025, they were talking about in Collier County. They didn't do it for Lee. They just did it for Collier County. The share of median income is 56%. What that means is that if you wanted to buy a home in Collier County, it would require 56% of the household income to get that home, right? So they say that the median household income is 100,000 in Collier County. The median home price, it's not the average. The median is, again, if you have bookends and you go towards the middle, each one you would end up here at the median. That's at 637,000. The interest rate is about 6.3. It's gone down a little bit now. They're just basically saying, hey, your principal and interest is over $3,500 a month. With taxes and insurance, it's over $4,700 a month. That's why they're comparing it to 56% of your income. Okay, United States right now it's at 43%. Okay, and what they would like that to see for as long as I've been around, they like it to be at 30%. So when they're talking about, well, housing is too expensive and this and that, well, depending on the area, they're absolutely right. Okay, it's a difference between Collier County versus, say, Punta Gorda, where obviously year over year it's gone down by like 13%. So these numbers, the 56%, even this interest rate has gone down, so it's less than 56%, and ultimately they'd like that number to be around 30%. Okay, so Let's talk about the prediction side. Was I right in 2025? So real quickly, I said that rents would remain flat at the lower levels because people didn't have discretionary income. I will drop further at high-end rentals. I was absolutely correct on that. Okay. I said insurance costs will rise slightly, but we should see some relief in 2 years. I've been partially correct about that because the flood insurance, we'll get into that as well, is a little bit different from the actual insurance. So the actual insurance in 2025 kind of stayed the same level. It went a little bit up for some properties and stayed the same. So I was partially correct there. Flood insurance, I said would stay high, affecting landlords and sales. I was accurate about that, that's for sure. Property taxes, I said, should begin to go down slightly or stay the same in November of 2025. So that's, again, they send out the taxes in November of 2025 to be paid at the beginning of 2026. Okay, that was correct. So for myself, several properties went up just a little bit. Several of my own personal properties went down a bit. So I was, again, accurate on that one. And then I said 2025 and 2026 will be a good time to buy investment properties cheaper, while understanding that the rents will climb in a few years. That's exactly what's happened. Where you can see in my fourth quarter video and stuff like that, you can see obviously that the prices of properties, their value, their sales have gone down. So what do I predict in 2026? So here we go. So I kind of did pretty well, maybe about a 9 out of 10, which is pretty good in 2025. So am I going to be as accurate in 2026? Well, first of all, I'm just explaining to you right now. Expect the rental rates to continue to slide all through 2026. So I know that January might be a good month, but I'm just saying over 2026, do not look for there to be any less supply or greater demand or anything else like that for a lot of different reasons. The rental rates will continue to go down. Also, expect insurance rates for investment properties to stay flat. Okay, so in other words, don't expect your insurance rates to go up. We've had about a dozen new insurance companies come back to Florida after we've had, various hurricanes, Ian being, 4 years ago or so. But also the flood insurance will continue to increase, I suspect, about 2 to 3%. That's obviously without having hurricanes involved. Again, we're not going to have any hurricanes again in this area. We don't need them. We've gone through our fair share. Also, I'm predicting that you're going to start seeing some increase in mortgage foreclosures in this area to increase slightly. Now, the Fed said, hey, credit cards under control right now, but given what I'm seeing on my end with people calling us and saying, hey, Michael, I can't sell my property. Let's take a look at renting it. And then they find out, well, they're still upside down and so forth. There are a lot of people, whether it's moving out of the area or just, a lot of different reasons, they're going to have some difficulty trying to control the debt that they have on the mortgage. So I'm predicting that, again, the mortgage foreclosures in our area are going to start ticking up. Now, when we talk about insurance and stuff like that, again, it's very tricky. I'm making predictions here, but it's very tricky because the federal government has said that they want to get involved with insurance, whether it's medical insurance. You're already seeing new prescription website trying to control the cost of some prescriptions. Medical insurance is a big expense for a lot of people. So we'll see if they also get involved with other types of insurance like homeowners insurance. I don't think so, but you never know with what's going on right now. So key takeaways from this video. Again, the Fed is not certain whatsoever about the future. They don't know. They were wrong about tariffs. They're saying that the economy is going to be kind of okay and almost like doing okay but stagnant. The projections so far have been wrong, and if they might be totally wrong for the fourth quarter when those numbers come out shortly. Okay, there's also going to be a change in the leadership of the Fed in, I believe, May of 2026. So that also is going to be something to look out for because that might change the policy and they might start to lower or be more aggressive towards the interest rates to get things moving. And stuff. And then, like I said, the predictions for 2026. Sorry, guys. Right now, I don't see it. The rental rates will continue to slide. There's a lot of excess properties on the market right now. And so until that's kind of absorbed with more people moving into the area versus building, the rental rates cannot go down, plain and simple. So if you have any questions, if you disagree with me on this video, which is fine, feel free to email me, Mike at redfortresspm.com, Mike at redfortresspm.com. I hope you found this informative. I try not to go too heavy with the numbers, but when you're dealing with graphs in the economy, sorry, numbers are important. Again, check out our YouTube video or go to our website, redfortresspm.com, and look under the blog section. I have all kinds of videos on investing, and I hope that you enjoyed this video just like all the other ones. Till next time, take care.